Hey investor friends, I'm Michelle and when you're a shareholder in a publicly traded company, you might expect to get your money back or a return on investment in a number of ways, one of which is a dividend where a company gives you back cash out of its earnings, and that's usually taxed both at the corporate level and also on the individual level if that stock isn't in a tax-advantaged retirement account, or also if the business just grows its core businesses or buys businesses and generates more earnings, and then that in turn might lead to a higher stock price in the future. Then you might have some capital gains if you bought at a lower price and sold at a higher price. And another way you can get money back is through companies doing stock buybacks or share repurchases, where it means that your slice of the company's pie becomes bigger because there are less shares outstanding, and your ownership in that company grows bigger the more that a company does stock buybacks. But lately, in the past few years, stock buybacks have become somewhat controversial because politicians have accused companies of doing too many stock buybacks, where perhaps it's at the expense of making the company's stock price look better than what it should be, and there's less cash to be able to actually invest in the company's core growth. So now, starting in 2023, there's going to be a 1% excise tax on public company stock buybacks, which kind of is not great, because if stock buybacks are done when the stock price is low compared to its intrinsic value, then stock buybacks are good. But when they're just being done at all-time highs and it may not be reflecting a good intrinsic value, then maybe that's too much to pay for your own stock. So sometimes companies' management haven't always been the best at doing stock buybacks and knowing what is the true value of the company's stock. And we can take a listen to famous investor Bill Ackman of Pershing Square Capital Management ask legendary investors Warren Buffett and Charlie Munger at the 1998 Berkshire Hathaway meeting if there's a limit to the stock price that companies should use their capital at which to buy back stock. Because if they just keep buying back stock at forever high prices, then that might not be so good, where it could be like just taking a company's cash into a parking lot and setting it on fire if companies could be paying too high of a price. But let's listen to what Warren Buffett said. And if you appreciate content like this, please be sure to like and subscribe and enjoy what you're about to hear.
Yes, Bill Ackman from New York. Is there a price at which it's inappropriate for a company to use its capital buy back its stock?
Give me that again.
For example, Coca-Cola at 40 PE. Is that a smart place for Coke to deploy capital?
Well, it sounds like a very high price when you name it in terms of a PE to buy back the stock at that sort of number. But I would say this. Coca-Cola's been around 112 years now, and there are very few times in that 112 years, if any, when it would not have been smart for Coca-Cola to be repurchasing its shares. Coca-Cola is probably, in my view, among businesses that I can understand, it's the best large business in the world. I mean, it is a fantastic business, and we love it when Coke repurchases shares and our interest goes up. We owned 6.3% of Coca-Cola in 1988 when we bought in. We actually increased that a little bit a few years later. But if they had not repurchased shares, we probably would own about 6.7% or 6.8% of Coke now. As it is, we own a little over 8% through repurchases. There are going to be about 1 billion 8-ounce servings of Coke sold around the world, or Coca-Cola products sold around the world today. 8% of that is 80 million, and 6.8% is 68 million. So there are 12 million extra servings for the account of Berkshire Hathaway being sold around the world. And they're making a little over a penny a serving, so, you know, that gets me kind of excited. And I think all I can tell you is I approve of Coke repurchasing shares. I'd a lot rather have them repurchasing shares at 15 times earnings, but when I look at other ways to use capital, I still think it's a very it's a very good use of capital. And maybe the day will come when they can buy it at 20 times earnings. And if they can, I hope they go out and borrow a lot of money to buy a ton of it at those prices. And I think we will be better off 20 years from now if Coke follows a consistent repurchase approach. I do not think that is true for many companies. I mean, I think that repurchases have become in vogue and done for a lot of silly reasons. And so I don't think everybody's repurchase of shares is well reasoned at all. You know, we see companies that issue options by the ton and then they repurchase shares much higher. You know, I started reading about investments when I was 6, and I think the first thing that I read was, you know, buy low, sell high. But these companies, through their options, you know, they sell low and then they buy high, and they've got a different formula than I was taught. So there are a number that we don't approve of. But when we own stock in a wonderful business, we like the idea of repurchases even at prices that may give you nosebleeds. It generally turns out to be a pretty good policy. Charlie?
Well, I think the answer is that in any company, the stock could get to a price so high it would be foolish for the corporation to repurchase its shares.
Sure.
And you can even get into gross abuse. Before the crash, the Insular utilities were madly buying their own shares as a way of promoting the stock higher. It was like a giant Ponzi scheme at the end. So there's all kinds of excess that's possible, but the really great companies that buy at high price earnings where that can be wise.
Our interest in Geico went from 33% to 50% without us laying out a dime, because Geico was repurchasing its shares, and we benefited substantially. But we benefited a lot more, obviously, when prices were lower. I mean, our interest in the Washington Post company has gone from 9.5% to 17.5% over the years without us buying a single share. But the Post or Coke or any number of companies don't get the bargain in repurchasing now that they used to. We still think it's probably the best use of money in many cases.
And so, like Charlie Munger said, there is a stock price that could be so high that it would make it foolish to do any more stock buybacks at that point in time. But it seems like that hasn't stopped companies like Berkshire Hathaway and Apple to do stock buybacks, because throughout 2020 and 2021, these companies did some of the most stock buybacks that they've ever done. And 2021 was an especially record-setting year for the S&P 500, where it had totaled $882 billion. And this year is set to be around $1 trillion worth of stock buybacks among the S&P 500. And yet some big tech companies like Apple and Google have maintained a high amount of share buybacks. And this in considering that Apple is only down 25% year to date, while Google or Alphabet is down about 40% year to date. So it's interesting how big tech with all of its cash is trying to help prop up their share prices, maybe they've determined that their stock is at such a good value right now that they might as well use the cash that they have on hand to plunk it back into their own stock, because they might be wonderful companies where it's worth it to keep doing share repurchases at even higher amounts. And all of this compares to how Berkshire Hathaway had been doing a lot of stock buybacks leading up to the end of 2021. And that culminated in Berkshire's share price reaching about $360 a share in March 2022. But since the first quarter this year, Berkshire pulled back a lot on their share repurchases, where in the first quarter they only did $3.2 billion. And in the second and third quarters this year, they only did about $1 billion apiece. So gradually, even though you would think Berkshire Hathaway's share price is even more attractive now that it's come down about 20% from its all-time high, and at the time I'm recording this, it was trading at about $290 a share, Berkshire isn't investing in their own stock as much. So maybe they found other equities or businesses that could be even more on sale than Berkshire Hathaway stock. And this year, Warren Buffett had written his annual letter that came out in late February 2022, where he was actually praising the share buybacks of Apple and also its CEO, Tim Cook, where he said that Apple our runner-up giant, as measured by its year-end market value, is a different sort of holding. Here, our ownership is a mere 5.55%, up from 5.39% a year earlier. That increase sounds like small potatoes, but consider that each 0.1% of Apple's 2021 earnings amounted to $100 million. We spent no Berkshire funds to gain our accretion. Apple's repurchases did the job. It's important to understand that only dividends from Apple are counted in the GAAP earnings Berkshire reports. And last year, Apple paid us $785 million of those. Yet our share of Apple's earnings amounted to a staggering $5.6 billion. Much of what the company retained was used to repurchase Apple shares, an act we applaud. Tim Cook, Apple's brilliant CEO, quite properly regards users of Apple products as his first love, but all of his other constituencies benefit from Tim's managerial touch as well. So this all goes to show that Warren Buffett approved of Apple buying back its shares even when it was reaching some of its highest share prices in the $170 or $180 per share range. And at the time I'm recording it, it came down to about the $130 per share range. But either way, it's good that Apple is increasing its share repurchases throughout 2022 as its stock goes down, because as we've seen, it's proven to be one of the best companies, and it could also be having its stock price kept up where it is, because a lot of people are doing some passive index fund investing, and a lot of that goes towards the highest market cap weighted stock in the S&P 500, which is Apple. So it's no wonder that Apple's stock price has been able to stay as high as it has been compared to something like the likes of Google, which Berkshire Hathaway isn't invested in, but yet it's come down significantly and it's fallen even harder than Apple's stock has. And so maybe it's a good thing that Alphabet is buying back even more of its shares now that its stock price is kind of beaten up. So overall, we can see that if a company is a wonderful company, especially as deemed by one of the best investors of all time, Warren Buffett, then maybe it's not so bad if even Apple is buying back its shares at some of its highest prices. But maybe it will temper some of that the more that the economy sort of calms down and starts to slow down based on a number of factors like consumer spending less and the Fed hiking interest rates, and also some challenges with getting iPhones produced in China. So maybe Apple will also slow down and maybe its stock price will continue to go down. But you would hope that Apple will just keep buying back its shares the lower its stock price goes, and then that will continue to enrich Apple shareholders. And it's interesting how also Berkshire Hathaway stock isn't down that much from where it started this year. Like at the time I'm recording this, Berkshire stock was only down by about 4%. So even though it had run up a lot, and a lot of that was thanks to Berkshire's own stock buybacks, it's also calmed down somewhat. And I could foresee that maybe Buffett is finding better opportunities to deploy the capital instead of buying back Berkshire stock, even though maybe it's still an attractive price to pay. But of course, none of this is advice. You have to do your own research to see what your understanding is of companies and what price you're willing to pay if you're willing to invest in these companies. And so if you enjoyed this video or learned something, please like and subscribe. And I wish you well on investing in the most wonderful companies. Till next time.